Hi, and welcome back to the Business Career College video series. In this video, we're going to look at an introduction to Canada Pension Plan. Now, you'll need to know about Canada Pension Plan if you're pursuing your life license, or if you're pursuing one of the investment funds licenses, or if you're pursuing a financial planning designation. We're going to cover Canada Pension Plan in a series of videos. And this first video, we're going to discuss contributions to Canada Pension Plan and how the plan is funded. So it is a contributory plan, and contributions are mandatory for anybody over the age of 18 who has employment income in Canada has mandatory contributions. And the rate of contributions presently is 4.95% of that employment income. Now, where that 4.95% places us depends on the year. So when the Canada Pension Plan was first introduced in 1966, it was actually a much lower rate of contribution. At that time, it was a 1.8% contribution rate. And the way it worked in 1966 when the plan was introduced was that if you earned anything over $600, you contributed to the plan on the income over that $600 threshold, and you only contributed up to your $5,000th of income. Now, those amounts have not stayed the same since 1966. The top amount, which is actually based on a figure that we call the year's maximum pensionable earnings, and this is an important figure. This is something that comes up over and over and over again in pension calculations and so forth, the YMPE. And if you're doing any sort of financial advice, you should be very familiar with the concept of YMPE. We actually get the YMPE from the year's average industrial wage. It's a survey done across all industries to determine what the average Canadian works or earns in a full-time position. As of 2014, the YMPE will be $52,500. And the bottom amount here, it did increase for quite a while. It leveled out starting in 1994, and since that time, it's been at $3,500. This is what we call the year's basic exemption. And today, we're no longer at this old 1.8% contribution rate. Today, we're at a contribution rate of 4.95% on those amounts between that level of income. And this 4.95% is paid by both employees and by employers. When an employee pays this, they get a tax credit for this amount at the normal tax credit rate of 15%. When an employer pays this, they get a tax deduction. Now, what this means is that for a self-employed person, they're actually paying both portions because they have to pay both their employer and their employee portions. So this means that the maximum amount somebody would contribute to Canada Pension Plan for 2014 would be $52,500, the year's maximum pensionable earnings, less $3,500, the year's basic exemption, meaning that we're contributing on $49,000 of income. And if we take 4.95% of that $49,000, you'll see that that means you're contributing $2,425.50. So anybody who earns $52,500 or more will contribute to this level, and if you're self-employed, you'll contribute that twice for a total of $4,851. So that's the maximum that somebody in total would be able to contribute in 2014. Now, what does this actually turn into? Well, as of 2014, the CPP maximum retirement benefit at age 65 will be $1,038.33 per month, or $12,460 per year. Now, we'll discuss in a later video the possibility of retiring before age 65 or retiring after age 65 and how that will affect your benefit. But for now, we're going to assume an age 65 retirement. So we're going to work through a few different scenarios here. We're going to look at what happens in different situations depending on how somebody has contributed to the Canada Pension Plan. So the first person we're going to work with is somebody who started working in Canada at a young age and has always worked in Canada ever since and earned a high level of income. They've always been at or above YMPE. We'll call this our green person. And our green person, because they have contributed to Canada Pension Plan to the maximum level throughout their entire contributory period, would qualify for the maximum. They would have $1,038.33 per month of benefits. And the way we would get that, not that it's complicated for this person, but they have 47 years of contributions, and for that entire 47 years, they contribute at a rate of 100%, or essentially they would get 1 full point per year, if we can put it that way. So we would take that maximum benefit times 47 years at 100% a year for, obviously then, $1,038.33. You probably don't have to do that math on any financial services exam, but it's not terribly difficult math. Now let's look at a different scenario. Let's imagine that we have somebody who has worked in Canada and earned sort of a moderate level of income all the way along and retires at that moderate level of income. We'll call this person our purple person. And so our purple person, we can see, contributed at a lower rate. So we say they contributed at, let's call it 60% all the way along. They always earned around $30,000 a year indexed to inflation. So they had 47 years at 60%. They're going to qualify for about 60% of the maximum Canada Pension Plan benefit, or in the vicinity of $623 per month. And then let's have a look at another person. We'll have a cyan person or a light blue person here. And our light blue person did not start working in Canada. They didn't live here, or they just weren't working, whatever it happens to be, until sometime in their 40s. Let's say exactly at age 40. In fact, they came to Canada and then they started working. And they had a while where their income was low, and then eventually they stepped up to a higher paying job. So here's what we have for this person. We have 22 years with zeros, and then let's say we've got 10 years in here where they're at a rate of 0.8, and that leaves us then with the last 15 years where they were at a full contribution rate. So for this person, for our light blue person, this is going to be a little bit more difficult math, but nothing you can't do if you just take your time and work through it. And again, probably not math that you actually have to do on the exam, but or on any financial services exam, but it's going to look something like this nonetheless, where we're going to have 23 years with nil, and then 10 years at 0.8, and then 15 years at a rate of 100% per year. Sorry, that's 22 years. I apologize. That's 22 years, not 23 years. I don't want to make this difficult math any more difficult than it already is. And out of a total then of 47 years. this person will then qualify for a benefit of right around $508 per month. And let's throw one more person in here. We'll use an orange person. So my orange person started working in Canada at a young age and was working here for quite a while, and then took some time out of the Canadian workforce and was away from the workforce for quite a while, and then went back to work and was eventually earning a decent level of income again. So let's say, for the sake of argument, that this person was at 0.8 for the first 12 years of their working life, and then they took, let's say, 15 years off, and now they had the last 20 years again at 0.8. So this person, our orange person, is going to have a similar calculation to the blue person at $1,038.33 times, and then we're going to have 0.8 times 32 years in total, the 12 early and the 20 late, plus there's 15 years with no contributions, out of a total of 47 possible years of contributing. And again, if you just take a second to do that math, you'll see that this person lands at a age 65 retirement benefit right around $566 per month. Now, there are a couple of important notes about these CPP retirement benefits. We should not overlook that whatever benefit you have here, it's going to be indexed to inflation. It's indexed annually to inflation, which makes it a very attractive benefit in that sense. And then the other thing to consider with Canada Pension Plan benefits is that all benefits, everything we're going to look at as we go through Canada Pension Plan, every last benefit is taxable. And we can't lose sight of that. That's a very important consideration. That's death benefits, that's pension benefits, that's survivor's income. All of it is taxable. And we know that. That makes a lot of sense because up here we saw that we have a tax credit and a tax deduction when we pay into it. So there's still a lot more to learn about Canada Pension Plan, but this covers the basics, and this shows us how sort of different people and different levels of participation in the plan will land us at different benefits. And you're not going to have to recreate this math, but I do find that it's useful for understanding to see how the different benefits get calculated. And we will come back later on and manipulate some of what's happened with these folks. I hope that's helpful. Thanks very much, and enjoy your